You own Walmart in a big way for your clients. Why do you consider keeping it, and what are you looking for?
Well, I think, you stated it earlier. One of the most universal stories of this earnings season has been a slowdown of the U.S. consumer, and specifically Home Depot, McDonald's, Starbucks, even Airbnb stated this slowdown is pretty prevalent and it's taking place. So when we look at Walmart, what we're interested today is we anticipate there's going to be a top line revenue slowdown, generally speaking, specifically from that low to middle income consumer. But what Walmart has done an excellent job of is attracting that high income consumer. And so we really want to see what they say. What kind of commentary is the higher income consumer hitting that same type of wall that the lower income consumers are? But more importantly, with Walmart, we really feel like they are doing an excellent job of insulating themselves even from this slowdown. And that's where, as a best of breed consumer staple, they do an excellent job of finding alternative revenue sources tied to big data, tied to the ability to cost cut and reduce the overall cost that they're incurring. So that's where Walmart can stand above the rest.
Well, Stack Financial clients have obviously enjoyed what's been a great run so far this year. That stock is already up 30%. It's leading to some concerns about whether the optimism has already been priced in. That 30% move has led to now a forward price to earnings ratio of around 29 to 30 times next year's anticipated earnings. Is that a reason for concern? And would you want to lighten up positions given the kind of run that we've seen?
Well, I think one of the biggest statements regarding that is we're not as optimistic regarding this soft landing scenario that the rest of Wall Street is anticipating. And so because of that, we think a rotation is going to continue to take place. And that includes a movement out of the big cap technology companies, out of the highly concentrated and overvalued segments of the market that include, again, technology, consumer discretionary, and instead, you really want to rotate towards more defensive areas of the market, consumer staples, healthcare, utilities. And so because of this, we think Walmart can continue to garner this more premium multiple because we've really bought Walmart in the past or over the course of the last year because of their growth profile. They've really expanded their e-commerce business and done a good job with growth. But now you want to hold it because of its defensive properties. They're able to continue to garner market share and capture market share from their peers. And that's that defensive property that we really think is why you want to continue to hold Walmart.
All right, so you've kind of laid out the cross-section between the macro and the micro, the expectations for a slowdown. How exactly would you be positioning outside of just the Walmart trade with regard to this particular move? Is it more into fixed income treasuries? Is it more into certain other defensive parts of the market?
Yes, both. Exactly. We think you do want to hold a more healthy cash reserve. For our managed portfolios, we are below 60% invested in the overall equity market. And the positions that we do hold are more defensive in nature. So specific names, if you want to look in the healthcare area, United Healthcare is another company that we continue to like. And they have that same general setup as Walmart does, where they have growth opportunities with Optum, but then they also have that defensive backbone of the health insurer. And then we also, utilities are an interesting segment of the market. They haven't benefited as interest rates have risen. But now, if we anticipate that interest rates might come down as the Fed anticipates a cut in September specifically, we think utilities make a lot of sense here. And there's different areas where you can just find those core utilities, pay a good solid dividend yield overall. And that's where you want to insulate yourself. So generally speaking, this idea of holding a higher cash reserve, maintaining a defensive posture in the equities that you do hold, and looking for that better buying opportunity down the road.